Hi, I'm Tekoa De Silva with Sprott Global Resource Investments, and I'm sitting down here today with Mr. Eric Sprott, Chairman of Sprott Inc. Eric, good to see you again.
Hey, Tekoa. Good to be here.
Yeah. So, happy to be sitting down with you. What are your thoughts here from a macro perspective when you look at the world economies, financial markets, gold?
Sure. Well, Tekoa, I've never been a believer in the economic recovery that we're supposedly in. I think that the powers that be are almost pulling out all the stops to try to hold it together. I kind of go back to the NASDAQ break, which I think should have caused a huge cascade of stock values to stay low for quite a while. And then, of course, the powers that be use whatever methods are available to them to try to stimulate things. And back in those days, it was like cash for clunkers and new home buyer tax credits. And then, of course, then we got the whole zero interest rate thing, and then we had TARP and TALF in 07, 08. We had conservatorships of Fannie and Freddie and AIG, which I'm sure nobody really much understands. And it's all trying to keep it together. And I think one of the things we learned in 07, 08, when Lehman went down, is that the powers that be can't allow a liquidation where a financial organization has to sell something, which unfortunately is what happened to Lehman, and it nearly took the whole system down. So subsequent to that, we've never had a liquidation. Even, for example, in the Cypriot bank crisis, the Cypriot banks never had to sell anything because they just took it from the depositors. It looks like in the Greek situation that we have today, the Greek banks don't have to sell anything because the ECB just comes in and supplies the emergency lending authority. Because I think if you allowed the market to function as it should function, where values are determined by the market, that we would see this sort of domino effect that if the Greek banks had to sell their loans off, and then the Greek stock market collapses, the bond market collapses, and then people around them start thinking, well, that could happen to me. And so we have this constant interference by the powers that be to not let the markets function properly, whether it's the bond market through low interest rates. I personally suspect that governments are in the stock market. We know the Japanese buy stocks. We know that the Swiss National Bank buys stocks. We don't know for a fact that the US government buys stocks, but there might be methods by which they can convince people to keep it together, because every time we get a little correction, it bounces right back up again. So that's just the environment we're in, and we spent all this money. We've taken rates as low as we can get them, and we're just hanging in there. And even recently, we had the GDP for 2011 to 2014 revised down, so that it turned out to be 2% a year. And of course the 2% is a function of the inflation rate. If you say inflation is 1, but it's really 3, then you had no growth, because GDP is just a dollar number, okay? And my own feeling is that inflation is way beyond what's reported. For example, if inflation really was 5 and you said GDP was 2, then the real growth is -3. And so I'm not a believer in any economic recovery that's sustainable. They always say we're trying to get liftoff. Well, we don't get liftoff because we haven't finished the cleansing process yet.
Do you feel that inflation is the goal longer term for the Western world?
Well, they talk about that. I mean, I can't believe that that's really the goal, okay? I think they use it as a reason to have zero interest rates, because they pretend that inflation's low. And I don't think inflation's low. There's an index called the Chapwood Index that measures 500 different items in 20 different cities in the US. And the index every year from 11 to today has been double digits. So imagine if it took double digits off 2% GDP growth, you'd really be shrinking at 8%. We had an example today where wage gains in the second quarter were 0.2%. Well, 0.2% in a quarter is like 0.8% for a year. I can assure you that everyone's increases in healthcare costs this year will suck up more than that wage gain that everyone's experienced. So, and somehow these costs don't go into the CPI thing. I don't know how they don't, but they're just not going to tell us what inflation really is. It's much higher than I think is being reported, and it tends to distort all the numbers. It makes GDP way higher than it would otherwise be, and tries to keep a certain calmness in a very, very difficult economic environment.
Eric, I've heard it said that when those types of disparities become too grotesque, inflation and wage growth and real wages, that disruptive events can occur within societies. Does that concern you? How much does that bother you as a person who has accumulated quite a bit?
Yeah. Well, I've actually been very surprised that there hasn't been more sort of disruption at the university level, for example. I mean, here we have all these people taking on all these loans with the promise of some job that they don't get. They can't possibly pay off the loans, and yet nobody seems concerned about it. In fact, how about if you're a university today and you know darn well that when your time comes to get the Social Security, there's not going to be any Social Security. That literally people of my era are benefiting at the expense of people that are going to be in your era. Because all these programs that we have, we can't afford them, but nobody wants to cut them down to size. Not on their watch, not while they're running the government, even though it's so obvious that there's no way that when you retire, the Social Security benefits that you've been promised can be paid. We already know that, for example, they just announced the disability fund is going to be out of money next year. And then the retirement fund will be out of money in 2034. Well, that's maybe getting near when you might retire. But there won't be any money there. So it's a very difficult situation. And yes, I'm surprised that there haven't been more people complaining. Maybe someday if, food prices went up shockingly high, perhaps because of the drought in California or other things, that's when, when you start affecting food and its availability, then people will be more disruptive. I don't like to even contemplate those things. I'd much rather just look at the economy. Okay, let's not get into how people are going to react, although it could be very negative to markets. I just know that the economy is not functioning smoothly, and sooner or later, because I have to care about things like this, stocks can't sustain these highs that they're at, and the banking system won't be able to pretend that it's solvent. And of course, it's the banking system not being solvent that always takes me to precious metals, right? When I think of the people in Greece who could only get, 60 euros a day. Well, if they had their gold somewhere, they could cash something in. They go to the bank and they got to get in a lineup and they get 60 euros in a day. I mean, that doesn't carry you too far. So I still believe that that's the ultimate manifestation here, that if there's no economic recovery, the banks suffer, people figure out that banks are risky, and the money goes to where it should do, i.e. precious metals.
How do you see that unfolding? How do you see that happening? In a gradual, contained method, or in some form of explosive manner?
Sure. Well, it's a great question. And of course, we had these examples where they got through Cyprus. Obviously some people were negatively affected there who had money in those banks. We're going through the exact same thing in Greece. There's been no bail-in announced yet, but if there's a bail-in announced in what we're going to call a little more developed country than Cyprus, then the countries around them who might be in similar type situations, maybe the people will start reacting sooner. I can think of Italy or Portugal or Spain or maybe some of the Eastern European countries. And it could catch fire very quickly. I'm not suggesting it will, but when you have people to start taking money out of the banking system in terms of deposits, that's when we all find out what the assets are worth if they have to sell them. Because when you have to sell an asset, it's nowhere near the worth of some quote in a newspaper or some housing index that somebody says, prices are up 5% this year. Now you have to sell it. You're not going to get that market price. The market will adjust to that.
Eric, in a moment I want to ask you a bit more about to use the phrase I heard you mention in the past, the physicalness of the gold market. But before I do, I want to ask, where do you find your greatest area of passion in being an analyst, as I've heard you say in the past?
Yeah. Well, I describe myself as being in the stealing business. And you want to steal value. You want to find something that is very cheap relative to where everything that's comparable already is, where it's almost assured that if you can buy something that's worth X and you're paying 2X for it, and you can explain to people why it's worth X, that's a pretty substantive gain. if you can also find something that today is worth X, but you think through the normal growth of that business or events unfolding that it could be worth 5X, and imagine that you buy something at 0.2X that becomes worth 5X. Now you've made 25 times on your money. So to me, it's always a great hunt all the time to find something that will be re-rated. And it'll be re-rated, one, just to get to normal, and then if it's really got the goods, then it will rise above the other comparative investments. So that's always pretty exciting.
Have there been any one or two re-ratings in your lifetime that you've experienced that really stand out as having been some of the most exciting?
Well, yeah, I've had many actually. One of the more unique ones is when internet gaming started, and a company in Toronto called CryptoLogic was essentially the first company in it, and I was a very early investor. I think I bought the shares at $1, and ultimately the stock went to $65. So that's a 65 bagger. I wasn't there the whole time, okay? I ended up, every time someone in the US Congress would try to pass a law to ban internet gaming, of course the stock would get pounded and then it would come back up again, and it was very stomach churning at the time. But it was a wonderful investment. And of course the internet gaming has survived and prospered, and the threat of government interference is massively diminished because everyone's going there now. So that's the sort of thing that's an example of one. I could give you other examples where I bought a company called it was called Bowflex at the time, then became Direct Focus, and they're mass marketing the fitness machines, and I think it was trading at $1 and it went to $35. And I was also in a company called Taser International, where all of a sudden the police department was taking on these taser guns as a safer way to suppress people than bullets. And I would have bought that very, very inexpensively. I don't even know what the price was, probably like $5, and it went to $120 as people realized, oh my goodness, this thing is catching on, and it was early days when I was there. So those are the sorts of things that you look for because you compound your wealth very quickly when you get what Peter Lynch called a multi-bagger. I mean, you start making 5 and 10 times in your money, you're seriously outperforming other people. So that's the sort of thing I like to look for.
How did you go, Eric, from being a value micro investor, looking at companies that way that you just described, to being, I guess I've heard my boss, Rick Rule, describe as a directional investor?
Well, of course, the reason I did that was before the NASDAQ crash, you could sense that the market was in for a great comeuppance here, okay? And I was kind of all over it. I could see it coming. And so I had to look for, how do I survive a market meltdown? Which we had a market meltdown in NASDAQ. I mean, it went down, 75%. And my studies indicated the only way to survive this thing is with precious metals. And as it turned out, gold bottomed in 2000 as the market was crashing. I think gold bottomed at $255. It went to $1,900, which is a huge gain. We're talking, 600% gain. The stocks went up by something like 1,700% in that 11-year period. And so because you had to dismiss the whole market, the whole stock market, you had to find some niche that could kind of carry you through it. And it's interesting, Dakoa, when I got into gold and gold stocks, I thought, I just want to hold on. I just don't want to lose money. And I guess I was very pleasantly surprised that rather than just holding on, it was a huge investment opportunity at the time. So it's worked out very well until the last 4 years, when it hasn't worked out at all. It's been, in fact, a disaster. But I think we'll have a rebirth here and get back to the good times.
We spoke about that a little bit already, the fundamentals for gold, but what gives you the confidence now that we'll see a rebirth in the mining equities, the gold mining stocks in particular?
Well, of course, you won't get a rebirth in the stocks unless you get a rebirth in gold and silver. I find it interesting as we sit here today, U.S. mint sales, I believe, will be up at least 400% year over year, okay? 400%. Gold is dead. We have a 400% increase in demand. In the month of July, the U.S. Mint stopped silver sales. And ultimately, silver sales for July, even though they missed about 2 or 3 weeks, I don't know what the number was last year, but I'm going to guess that we're up at least 100% with 2 weeks of non-selling. So you can see that there's a move afoot here. It's not just in the U.S. mints, the Royal Canadian Mint in Canada, the Perth Mint, even a company called Sprott Money, where we sell coins on the internet. Our business was very substantive in July. So the people are coming in to buy. I suspect that as we're moving in here to the second half of 15, normally the physical demand out of Asia, particularly India, really gets going. So there's lots of signs that there's true interest in gold, and if the interest in gold comes back, of course, the leverage in the stocks is mind-boggling in my mind. I mean, when the UE index was last at, I guess it's around 110 or something. I mean, the price of gold was probably 400. Today it's, let's call it 1100. So you'd think that, you know, there's a lot of torque here if people actually started to believe that gold was going up. Most people probably, the market thinks gold's going down. So they're probably pricing maybe 800 in the gold stocks today. Well, if it ever reversed here, I mean, there'd be a lot of catching up to do. So that could be very exciting if it manifests itself. And I believe that the physical buyers are there. The Russians are buying, the Chinese are buying, the Indians are buying, people are buying. You'd imagine everybody in Europe would be thinking, okay, we got Greece going on here, and is there going to be another one? And where is that other one? And, you know, maybe people will, and there has been good sales in Europe recently of gold coins and silver coins. So you get enough of a groundswell, we could find out that we have shortages very, very quickly.
What would need to happen, Eric, to convince you that you could be wrong about all this that we're talking about, gold,
sure,
the mining stocks? What would you need to see?
That's a great question. I mean, well, one might even say I have been wrong in the sense that they've just crashed here. But, you know, you look at the financial system out there, which I would almost use the word Ponzi to describe it, and certain things happen that probably shouldn't happen. And all of your logic, my logic says, well, that shouldn't happen. The stock market shouldn't be at a new high. Bond yields shouldn't be zero interest rates. We shouldn't be printing money. Gold should be higher. And ultimately, when you see the evidence that suggests that those things you're thinking about are still going to play out, then you just hold on. And there's nothing that, I mean, we have to listen day after day to how great the economy is or how great it's going to be going into 2015. You know, it's going to be 3.5% growth. Well, we're going to be down to probably 1.5 by the time we end the year. We do it every year. 3.5 ends up at 1.5. 3.5 ends up at 1.5. I mean, 1.5 is just it's a rounding error in a way. So there's really nothing substantive going on in economies. There's no reason that the stock market should have gone up by whatever the number is, 200% in the last few years, and we've had no growth in the economy to speak of. And yet these stocks are trading at record high prices. So long as the logic says you should stay there, I stay there, and maybe it goes lower. It'll make the opportunity that much bigger over time.
Physicalness of both gold and silver. What do you see here in the world that you like?
Well, for the last 15 years, I see evidence that there's probably, in a gold market that has 4,000 tons of supply, I see 6,000 tons of buyers. And you know that the 2,000 tons has to come from somewhere. It's got to come from Western central banks. And I think these Western central banks are depleting their gold resources. And someday they're not going to be able to make the payment when somebody demands the gold. And of course, the guy demanding the gold will be either Indian or Chinese or, you know, the U.S. Retail coin buyer, people like that. And all of a sudden, people will realize that, you know, the demand was always way above supply. And the same thing for silver. I mean, I look at what India's done in the last 2 years. I mean, they're buying 30% of the silver market, up from 10%. How is it possible you could buy an extra 20% of a market and have the price go down? I mean, it's mathematically challenging to come up with that conclusion unless, you know, somebody in the paper markets just wants to make the price whatever he wants to make it. And hey, somebody who's got deep pockets can make the price do anything they want, long as they don't ask for the silver. So I'm pretty convinced that the physical argument is a very powerful one.
Eric, I want to ask you now, you've made multiple fortunes.
And lost multiple fortunes.
Throughout your life. You deal with business builders on a daily basis. You've received an award, I believe it was to be part of the Order of Canada, the highest civilian award that can be offered by the country. What have you found with your own life and from your observations to be the formula for building wealth for a person and to deliver that wealth to society, to become wealthy, sure, not for strictly financial terms, but to have an abundant life?
Yeah. Well, I mean, I'll go back to why was I able to make contributions to my country and various charities and things like that. You can only make contributions if you make money, okay? I mean, if I was making 50 grand a year, I can't be supporting universities and hospitals and things like that. So first principles, you have to find a way to make an outsized return. And I didn't start with a large amount of money, okay? Just like anyone else starting off, making my $4,800 a year, saving a little, investing, having it grow. And then I think the key thing is you have to be, I'm gonna say a risk taker, but the risk is really only whether the market is going to see it your way. So for example, when I describe, buying something you think is worth 0.2x, and yet the market typically, if they understood it, probably would value it at X, you have to hope the market comes along and provides you with that return. And it always seems risky at the time. I mean, buying gold stocks in 2000 probably seemed like the dumbest thing anyone could ever do. We had hitting the low in gold, and I'm out there buying all these gold companies. Well, I guess I was looking for some kind of outsized return. I got that outsized return. You have to go against the crowd quite often to do that. But at the same time, you see evidence of something coming together that you believe in. One of the great evidences, by the way, particularly as applies to an individual stock, you're sitting there analyzing a stock, you say it's cheap. You start to buy it in the market, and all of a sudden it starts to go. You know why? Because somebody else knows it too, and now you're competing with them. And if you start buying a stock at $2, and the next thing you know it's $2.50 a week later, you kind of know you're onto something. Because it's not just you. You're not going to take it from $2 to $2.50. You'll sit there and buy it at $2 if you can. But somebody else is also doing it. And then you realize, okay, I'm not the only guy in this game here. There's others who recognize it. And normally when you get that kind of jump start on things, it tells you that the 0.2x could become X. And then it's kind of an easy road, right? Because, okay, we got a few more guys on board here. One of the things that I like in a stock is that no one covers it. I prefer there's no analyst cover a stock, because then all you can do is bring them in. You're not going to lose anybody because no one's covering it already. And the next guy in, of course, is going to write a bullish report on it. Otherwise, why would he be there? And if you can beat them to the punch in terms of analyzing the value, you're going to have that groundswell of interest come behind you, which would force the issue to get back to X again.
Work ethic. Do you punch out at 5 o'clock?
Well, I sometimes quite often punch out at 5 o'clock, but I start a little earlier than the average guy, okay? I mean, I can be up at 3 or 4 in the morning. I'm almost always by 4. So by the time, if I get to the office at 9, I've essentially done 4.5 hours of work already, which I love doing. I mean, it's a great time to work. You're on your own. You can do kind of native research. You can investigate things. I mean, that's one of the great things about the internet. You can, the way to garner information is so easy now relative to what it was like in my day. I mean, in my day, you used to have to go get the quarterly reports, the annual report, and read them. Now you can just go to the various websites. They're all right there. They've probably all been analyzed for you. They get all the ratios and things like that. It was a lot more difficult, but by the fact that other people maybe wouldn't put the effort in back then, or it was more difficult, it gave you I think, a better launching pad, that if you finally found something, you looked at everything from a numbers basis, it looked good. And reading the inner reports and the company's forecast, you could get a leg up in things. And I mean, that still exists, because I think that, you know, the use of analysts has diminished a lot here, because we have this market that just everything moves together. So the benefit of separating, you know, A from B can be quite significant. If A looks like it's, you know, trading at 20% of where it should be, it can catch up to the market and you can get an outsized return.
Eric, in winding down, is there anything you think we may have missed?
Well, I think the biggest thing that probably we haven't talked about is, you know, where is this all going in the long run? How can we sit back when all the analysis out there tells you that so many countries are way beyond their capacity to service their debt and their obligations? And it's the obligations that are the big thing. We constantly reading about underfunded pensions, and, you know, it's always something that, well, that'll happen 5 or 10 years from now, okay? But in some instances, it happens today. It happened in Puerto Rico today, I think. It happened in Detroit 6 months ago. It'll happen in Greece. It's just ongoing. We don't even know where it's going to happen. And there's so many other kind of either black swans or mini black swans that you know have to happen. They have to happen sometime. So I think the most important message you can leave people is that you're dealing in a market that is very unrealistic as to long-run expectations here, that the long-run expectations, unless things dramatically changes, and they're not likely to dramatically change because the powers that be don't want to have to admit that there's a problem now. They want to delay that announcement. Or it's like Detroit put off their bankruptcy for 10 years. We knew 10 years ago they were bankrupt, but, you know, they waiting, and finally, you know, someday they couldn't write the check and they declare bankruptcy, to our great surprise, right? And I think that's the biggest thing. Where is this world going with all that debt and the unserviceability of the debt and the other obligations that they have? That's by far the biggest concern. It's hard for investors to take that long view, but we all know where it's going someday, so be prepared.
Eric Sprott, Chairman of Sprott Inc., thank you for sharing your comments with us.
Okay, Takao, always my pleasure.